Hello and welcome to the Finance Quarter. I'm Andrew Robertson. Retailers are having a tough time at the moment, and all the signs are that conditions are going to get even tougher. Not only are consumers winding back their spending in the face of higher interest rates and a desire to pay off their credit cards, but now the internet is changing the way we shop. For many bricks and mortar retailers, it's a threat to their very existence, as we've seen in recent times with two of Australia's biggest book chains in Borders and Angus & Robertson being placed into administration. Retail is changing, and whether the existing players like it or not, internet shopping will only get bigger.
It's now put into the hands of the average consumer the ability to be able to research every product and service and to be able to see prices and compare prices from a whole bunch of retailers, and therefore to have the power in negotiation terms to be able to go into a store and say, I've seen this somewhere else cheaper, I know exactly what I want, I probably know more about this item than you do, so don't talk to me about that, this is what I want, this is the price that I've gotten, are you prepared to match it, or I'll walk out.
Which means that although the internet only accounts for about 8% of the $240 billion retail market, it influences 100% of pricing decisions. It's hitting the bottom line hard, and that's why a group headed by Harvey Norman boss Gerry Harvey and Just Group owner Solomon Lew is campaigning to end the GST exemption for online imports of under $1,000. Internet business services provider Net Registry is a member of that group, which is known as the Retail Coalition.
It's a reverse protectionist measure by the government that supports foreign retailers at the expense of local retailers, and it's distortionary. It's distorting that equal playing field across the globe that I think the proponents of globalisation support.
But not all retailers are impressed with the Retail Coalition's tactics.
I think they've done a significant amount of damage to the brand of retail, and I think they've done damage to the issue about reform.
Here's a couple of examples which undermine the argument that the GST exemption on online sales is hurting Australian retailers. This is a Manchester United soccer shirt which sells for about $130 at stores like Rebel Sport. You can buy it online in London and have it delivered to your door here in Australia for well under $100. Dymocks sells hardcover copies of Harry Potter like this for $45. It costs just $21 on Amazon.com, which is less than Dymocks can buy it for wholesale. Russell Zimmerman is head of the Australian Retailers Association and also owns two shoe shops in Sydney. He believes traditional retailers should stop whinging and instead embrace the net.
It's vital that they are part of the internet. They get involved in that space, that they have a competitive offer on the internet to ensure that those customers who prefer to shop via the internet and don't want to come and buy their goods face to face have got the opportunity to buy them on the internet. If you're not there, then don't complain about the fact that your business is being eaten away by the internet.
With internet sales tipped to double in the next 4 years, retailers are pinning their hopes on the recently announced Productivity Commission inquiry into the industry, finding some long-term solutions. Get-rich-quick schemes have been around almost as long as mankind, but often in trying to get rich quick, you run the risk of becoming poor even quicker. One of the most precarious is trading in derivatives, but increasingly more and more people are going down that path, seduced by the prospect of easy money, and frankly, they're playing with fire. Well, I'm sitting outside the offices of financial markets expert Asyut David, where I've come to seek her views on who really should be trading in derivatives. Asyut, in simple terms, what is a derivative?
A derivative is an instrument where the value of the instrument is derived from the performance of an underlying security. Examples of those may be options and futures, and often they're used to take a position on the direction of the price of the underlying asset, so that may be the price of an underlying share or a commodity.
If you browse the internet, there are thousands of sites which tell you that anyone can trade derivatives and anyone can make lots of money from them. Is that true?
I don't believe that's true, because derivatives are a high-risk instrument, and while you can make money from them, you can also lose a lot of money as well.
Now, derivatives magnify your exposure to the market, so you put in a little bit of money and you have exposure to a lot of money. How does that work?
Okay. So what happens is that when you buy, for example, an option, what you may do is put in $100 but that may give you exposure to, say, $1,000 of the underlying, say, the share. So if we use shares as an example. And so the magnification of the losses or the gains is quite significant. If you compare that to something like margin lending, often what happens is an investor may put in 50 cents of their own money and borrow 50 cents. So the magnification there is only one-on-one, if you like. Whereas with derivatives, the magnification can be substantially higher. But there are other risks attached to derivatives as well.
Well, we'll get to those other risks in a moment, but it's often said that the potential losses from derivatives are unlimited. How does that work?
Okay, so when someone is taking a position on a particular, say, a share, if they're taking a position that they believe that the share price is going to fall, they may do something like sell an option. And so therefore they're betting that the price of that share is going to fall. However, if the price of the share actually increases, then there's no limit on the increase in the price, which therefore means that there's no limit on the downside or the loss that the option trader can necessarily undertake.
And that's the main risk?
No, there are a number of other risks relating to derivatives. So the other risks include the fact that the instruments themselves are quite complex and they're hard to understand. Even institutions or people who operate in the investment space often need to do quite a long accreditation course to understand how they operate.
And of course, back in the 1990s, we had the collapse of Barings Bank, all through derivatives trading gone wrong.
That's right. And so even institutions or investment people who operate in the investment space can get it wrong, and get it wrong quite badly, as we saw in that situation. And most institutions tend to limit the way that derivatives are used and also who can use derivatives. And there needs to be a long accreditation process before many institutions will allow someone to even deal in derivatives.
Well, given what you've just said about the big institutions, bringing it back to the man and woman in the street, who then should be trading derivatives?
In my view, I don't think that the average mum and dad or average investor should be trading derivatives at all. I think that the risks involved are quite substantial, because the other thing too, which we haven't touched on, is that often derivatives tend to be based on a short-term time frame. So they're generally taking a position on the price of the underlying security, say over a 3-month period, which is extremely difficult to predict, and especially if you're talking about other assets such as currencies, which are well known to be very, very difficult to predict, particularly over short periods of time. And so once you start to layer all the different risks involved, so you've got the risk of taking a position on a short-term over a short-term period, you've got the magnification of the losses and the gains through that, you've got the complexity of the derivatives. Once you take all of those things into account, to me that says that the average investor out there should stay clear of derivatives.
So the message is take care.
Definitely.
Asif David, some great advice there. Thank you very much for your time.
Thank you.
For many business people, one of the biggest issues they'll face in 2011 is the high value of the Australian dollar. With the Aussie hovering around parity with the greenback, exporters and import competing industries are being smashed, with one of the most obvious examples being tourism. We asked 5 experts to look into their crystal balls and give us their views on where they see the dollar heading this year.
I'd be thinking that potentially it could end the year somewhere in the 80 to 85 cent range, so I'd be a little bit cautious on where the dollar is. Right now it's very expensive. It's had a lot of currency positive news over the past couple of months on commodity prices and positive risk sentiment by investors, and it's basically been in a range which to me suggests that it's starting to run out of steam. And when I think about the big currencies, the yen, euro and US dollar, it's really a case of which of those looks the least ugly and has got the most upside, which I would say is the US dollar. And I think the US dollar will end the year stronger, which means I'd be looking to see the Aussie dollar end the year a bit weaker.
The Australian dollar is the hardest of all variables to predict. By the end of this year, I suspect that it will have come off around 10% from its current level, so about 90 cents against the US dollar, and that's based on looking at higher interest rates overseas. Of course, that's all predicated on there being more recovery in the US, more recovery in Europe in particular, which has been holding the currency up for a long time here. We've also seen strength in commodity prices, but I don't expect those to go a whole way further than they already have throughout the course of the year. So we'll see relative